Good morning, everybody, and welcome back to Beat the Bell. Happy Friday. Happy almost Halloween. Hope you guys have had an awesome week thus far. So, turbulence in the markets. We've been talking about it. Things are not, at least yet, getting any better for bulls. This earnings season has been an absolute landmine, and things have looked ugly. So, for that reason, we have our friend Matt back on the show this morning to talk commitment of traders, to talk monthly maps on Rocket Scooter. Looking forward to that. Matt, happy to have you back on the show. Thanks for joining us.
Thanks, guys. Appreciate it.
All right, Money Mander, good morning.
Good morning. Happy Friday. Volatility is back. All I got to say.
And Diamond Trades, good morning.
Morning. Happy Friday. Let's get after it. A lot to cover.
What's on your shirt there, brother?
This is a Nike guy. This is a Nike guy, and then on the bottom it says "Soul Food," but like sole of a shoe.
Yeah,
soul
we get
food.
it. We get
You
it.
like that?
Yeah, nice. All right, Fed forecast and economic calendar.
Yeah, let's do it. We can start with the economic calendar. Really, not much on the economic calendar front. We had core PCE today, which came in more or less in line with expectations, 0.3% month over month versus 0.3% expected. Personal income came in at 0.3% versus 0.4% expected. And then personal spending actually ticked up to 0.7% versus 0.5% expected and 0.4% previous. But more or less everything else in line there. We do still have UMich at 10 o'clock, Michigan Consumer Sentiment. So definitely something to pay attention to there. Let's go ahead and go over this week's trading. The markets have continued to slide as key technicals have continued to break down. The S&P 500 has lost 2% so far this week, with the Dow down over 3%. I'm sorry, with the QQQ down over 3% and the Dow down just over 1%. Yields have retreated intra-week, but not before crossing the psychologically important 5% threshold, leaving investors concerned about the impact of a higher cost of capital will have on businesses, particularly those that have yet to turn a profit. The ARK ETF, which houses several of the world's favorite growth names that may or may not be profitable just yet, is down another 3.5% this week and down almost 32% off of its summer highs. Thursday gave us a hotter than expected GDP print that showed consumers are still doing their part to boost the economy. But some wonder if that trend will keep up into Q4. The level of consumer spending isn't sustainable in the fourth quarter, said Megan Horniman. She's a chief investment officer over at Veritas Capital Advisors. The GDP report was a mixed bag, showing that Americans saved less and their incomes fell when adjusted for inflation, as well as stalling business investments. Let's go ahead and dive into the Meta numbers. Meta reported earnings on Wednesday. So Meta shares fell 3.7% yesterday after the company beat analyst expectations on earnings, but lowered guidance on Q4 ad expectations. EPS came in at $4.39 per share versus $1.64 per share. Estimated revenues came in at $34 billion versus $33.5 billion. In its Q3 earnings report on Wednesday, Meta revealed that its Reality Labs unit, which develops metaverse-related technologies, recorded a $3.74 billion operating loss in its third quarter. Right, so that $3.74 billion operating loss is actually right in line with what they lost in Q2 and a little bit less than they lost in Q1. So bringing the total for the year up over $10 billion in losses so far for the Reality Labs division, which obviously does not look great on the surface. But some analysts do believe that Apple's entry into the VR market could help spark additional mainstream interest in the sector as a whole, which could help Meta's sales. Meta has positioned this new Quest 3 headset, which debuted this quarter, for $499 as a cheaper alternative to the Apple's VR headset, which is the Vision Pro Max, which is expected to cost like $3,400. That's supposed to come out either this quarter or next. So when that does come out, analysts are expecting that that's going to, create a bit more buzz around the sector as a whole, and maybe that will help Meta's sales going forward. Mander, what are you looking at coming into the end of the week here after we've gotten all of our news and all of the big earnings that we've had so far this week?
Crazy week. I think going into today, we'll have to see, and it's good we have Matt on here today to talk positioning going into today, because on the surface level, Amazon, which I'll cover here in a second, big beat, gapping up here in the indices for really the first time all week since that Monday, Tuesday rally we saw, just discussing sell-off here into the end of the week. So we'll see what we get in terms of price action, but let's cover Amazon, because this is a company that is turning a profit and turned a really record one this past quarter. Revenue's $1.43 billion versus $1.41 expected, so about a $2 billion beat on revenue. A record operating income over the quarter, hitting $11.2 billion compared to $2.5 last year's third quarter, so up 350% year over year. Obviously led to a record net income then of $9.88 billion versus the expected $6, for a 60% beat on EPS and up 236% year over year. And so all those numbers on the surface were great. But as you saw what happened to Google, you can beat on everything across the board. All investors wanted to see this quarter was how your cloud services were doing. And so AWS revenues came in plus 12% year over year, which was actually flat. It was exactly what they did in growth last year to the year prior in year over year growth, up to 23.1 billion. So I think this was the big number to watch, is that while their year over year growth was only half that of Google's cloud services that they reported, they 3x Google's revenue. And so clearly have a massive amount of this market share here in the cloud services space. And I think this one was just seeming that, it's tough to continually be impressive when you're the king of the hill here. It's tough to continue that trend of growth, but it was seemingly good enough to let the rest of the numbers here shine, as Google now trades up here plus 5.5% going into the open today. So we'll see what we get here. The next thing I wanted to cover is this is the alternative. The CBOE equity put to call ratio closed yesterday at 0.90. And so if we go ahead and take a look at this chart, this is really when you started to see the markets become, at least in the very, very short term, quote unquote, oversold. And so going into today's session with the gap up, with the Amazon beat, a lot of these names getting destroyed like fire sale all week. I think there's a plausibility that as a lot of these open puts that were taken on as hedges over the week then start to roll out of the money and dealers close those short hedges for the puts they sold, there could be the potential for a small Friday rally here. But I'm glad we have Matt on here, because the sentiment has obviously been short every pop. And we'll have to see what positioning is saying going into today, whether the Amazon gap up can potentially save the markets for a day or two.
Yep. Thank you. Love it. That'll wrap it up for us here. If forecast, pass it back to Alejandro.
All right, guys, we're going to quickly look at some TA, the same stuff that we've been looking at in the S&P Futures ES. So we know that this is the major bull market trend line that we've been keeping an eye on, correct? The last time we did the show this past Wednesday, we were looking at this potential failed breakdown where we had broken down below the recent October lows. I noted that if we broke down below the low of this move, which was 42.13, then that would of course, be bearish, because that would invalidate the failed breakdown that we had gotten before. So we broke down and we've seen weakness since. This, to me, guys, remains the trend line that needs to be reclaimed, sitting currently up at around 43.60 ES. The reason that this is so important is because it is, again, the major bull market trend line connecting the October lows and the March lows. We've seen really nice price action, and we've seen the importance around this trend line. So watch for that. But that should also be letting you know that anything below here, and why we've seen this recent weakness, is because we gave that up. So keeping an eye on that. And then, of course, trading below the October low has also been bearish for the S&P 500. So now we're going to go over to Matt. And the reason I wanted him to come on today's show is because when things start to go down and things start to get ugly, people want to know why. So I asked him to come on to talk about commitment of traders and to take a look at the monthly maps that Rocket Scooter provides us with. Matt, what are we looking at in terms of that stuff?
So good morning. I'm going to share my screen really quick if you can see it. We're staring at something that's actually, it's a I guess an entire game changer to the market. What happened? And it's interesting to see, because earlier in the year, we were extremely bullish around the summertime. All signs were looking great. Market was just flying. And then right when we had the Fitch downgrade, the minute we came out. So what monthly maps does is it shows you a distribution of positions, bull and bear positions against the house. And right now I'm looking at the S&P over here. So this is SPY. So the house would be the dealers or liquidity providers who try to find where that line in the sand between where the bull kind of ranges and the bear ranges. And so normally, you have these nice, clean, I'm going to over here to the right, this is a little cheat sheet on how to watch it. Normally have these nice, clean distributions where you have like a straight bear side and a kind of like a straight bear bull side, and it's just nice and clean, but you see it just looks like shattering all over the place. When Fitch happened, for whatever reason, that changed the dynamic of the market. I remember after that happened, our tone changed immediately. That very next day, I think it was like a Thursday, we were saying, the party's over. We were thinking SPY 500 by the beginning of the year. The Fed was relaxing what they were doing and market was running bullish. And then that one event changed everybody. And you saw that positional shift kind of run out. Now, since then, since August, since the beginning of August, we've seen the market kind of stabilize and just work its way down, like lower, but not crashing. It's liquid enough not to crash, which is good. But you weren't seeing in the monthly maps or the positional data showing that the market was ready to just plunge. You had bears covering and long selling all at the same time. So you had buyers and sellers still kind of there, even though it was working its way lower. And then after expiration this last Friday, we made a tweet on Monday that was like, warning, warning, warning. This is the first time in a year that we've seen this. And I'm going to draw this part that I'm circling right here on my screen is the most important thing you're going to learn from me this year. This little slope up of these bull positions is the worst thing for the market you can see in Friday. Monthly map showed like a great market going to expiration, but Monday morning we woke up going to earnings and the market was ready to sell. When you look at this, the bottom of these little bull zones sloping up, it means bulls are exiting positions. This is an actual bull liquidation event. We haven't seen one of these since the market started rallying a year ago. Bull liquidation events are bad. This is people literally finally having enough with the market and getting out of the way. So when you see this, as time goes by, there's going to be more and more selling. This is about 2 weeks of data this projects into the future. So on Monday, we said there's about 2 weeks of very nasty selling pressure. Bulls are exiting. Not only that, if you look at the bottom side, which is the bear side is relatively flat. Not really doing much over the 2 weeks. It kind of bumps up and then comes down. But so when the bears are doing absolutely nothing and the bulls are selling, there is no buffering, right? The bears aren't covering their shorts to buy. If you look over here, if one can argue it's slightly slipping up a little bit, that would be the shorts are covering a little tiny bit, but it's not enough to offset this much selling. It's relatively flat. So what you're not seeing what you had before. Was shorts were covering on every dip because they've been upside down for a year. Right now, the bears are hanging on and the bulls are selling. There's a hole in the market and it's going to fall. To go with that, when you see the distance between bull and bear zones over time, as the cheat sheet will show you, and all this is available like in our Discord, if you guys ever want to come take a look at this, how to read these things. The volatility is increasing right here. See that? So when the volatility is increasing, your moves are going to get wider. Like if this is the S&P trading lower, it's going to get wider. And those levels you talked about, I 100% agree. We're going to have a hard time reclaiming some of that level because of the volatility. It's not just selling, it's volatile selling, which means the floor is going to get thinner and thinner as we go down. It's going to be hard for the market to find buyers over the next couple of weeks. So earnings is going to be pretty gross. And on Monday, it was essentially, our call was it's going to be shorting pops every single day. And the market is just, it's no longer doing what it did before, which was, intraday trading would kind of just like move around. I mean, right now we're getting swift red moves, right, throughout the day and trading lower. That's that velocity that's starting to pick up in this kind of bearish run. Now, why is it like this? What is causing this to finally be the breaking point to some of the bulls? And it's hard to say, obviously you see bettering economic conditions. Right. GDP growth is looking great. Employment situations it was looking great. It's kind of looking on the fence again, but not terrible. I think that right now, this is just probably a seasonal thing and an earnings thing. Right? Earnings season is very much front and center now. And I think people just have seen that the velocity's gone in the market and there's other kind of plays. We have problems in the bond market and things like that are causing people to shift their money around. And it's really hard to see where it's going. I think right now, people are just kind of walking away from major things in the S&P and kind of moving into tech. I think tech is still kind of strong. I think banking is kind of weak. So this could just be, like an overall broader thing of people rolling out of some of the more troubled sectors in the S&P. And maybe we'll find a safe haven in tech, and maybe the NASDAQ, stocks will kind of start looking a little better. NASDAQ has a similar look. This is just gonna be a really nasty couple of weeks. And if you want to see that just as a summary, bulls are selling, bears are holding kind of flat. After about 2 or 3 weeks, it's still kind of jumbled up, but in general, you start to see that the the bear side position goes back to squeezing. So I think the next big low, 1 or 2, are going to be up and then sort of hold it for it. So I just think it's going to get worse before better. And it's very easy to see that. And we can reflect on that sentiment going into the commitment of traders. This is the same kind of type of analysis, but this is using the futures reported to the CFTC. So by like large institutions, asset managers, and hedge funds, as we were talking about a second ago, we're showing a bull liquidation event. As you see this green line slipping down, these are the asset managers, the long side of the market, and the net long position has just been selling, since about here. This is the S&P futures. So right about here, we've had a kind of a net loss of long position. People are vacating the long side of the market as well. So while monthly maps are using options and SPY to show that reveal and SPY, the CFTC is showing these, weekly data points showing that same reveal, asset managers liquidating here. And then what we showed a second ago was that, next couple of weeks, bears are kind of holding flat. Your hedge funds are typically your bear net contrarian side of the market. They're relatively flat as well. So committed traders is also showing something similar in futures. You have selling into kind of like, bears holding the fort. Bears aren't covering enough to buffer the selling. If you have, shorts covering and long selling, that creates some interesting liquidity. Like when these two pinch together, that the market itself doesn't just collapse. Like here's a time when they're pinching together. It just kind of like starts to buffer any selling, and then sometimes it catches a bump. And so while if they start pinching together, this could start to stabilize. But the fact that they're not doing that, this can get really bad before it gets better. So we're expecting some more downside. It could even be as much as testing this little kind of value area at 4,000 if it goes even worse through earnings. So we have 2 weeks of nasty selling, and I've kind of been like some of the first few times that I've shorted the market in a while. I've still kind of bought dips through here, but now I'm just kind of taking that short side. So in general, it's kind of like this is a trying 2 weeks, and we'll have to see what happens when we get out past, the 6th or so of November and kind of see what the sentiment is there. But after a monthly expiration, we woke up Monday morning and it was just like, whoa. We had an emergency meeting in our community to go over this. That's how bad it was. We're like newsflash. So it's basically it going forward. Hold on to your hats.
All right, Matt, appreciate you sharing that stuff with us. Really good and very clear being able to see it, because we have had you on the show. You mentioned earlier in the year when everything looked really pretty. And that's the good thing about Rocket Scooter, being able to go in, whether you're checking the daily maps or the monthly maps, daily, weekly, you go in, if things change, you're able to quickly change your thesis and pivot. And there's no need to hold positions that are down, because things change very quickly, oftentimes more quickly than we could imagine. So awesome stuff, Matt. Really appreciate you coming on the show. Appreciate everybody that tuned in, guys. That's going to do it for this week on Beat the Bell. Thanks for joining us, everybody. This has been a fun week, crazy week in the markets, as we've been mentioning. Hopefully things do start to smooth out, but based on those monthly maps, we're probably in for some more tough trading for at least a few more weeks. All right, guys. Have an awesome rest of your weekend. Be safe Halloween if you're doing that type of stuff. Other than that, take care, guys. And we'll see you on Monday morning at 8:30 a.m. Eastern.